some more insight and analysis on the commentary coming out of the Fed and the market reaction. Michelle Schneider is Managing Director of Market Gauge Group. Mish, it's always nice to see you. I guess I'll start with the market's response to these comments from the head of the Fed. Should they be surprising?
Well, it actually always intrigues me how honest Powell is, even if it makes him look kind of odd, because he clearly is stating that he was so behind the eight ball in inflation, so now he's just focused on inflation. He realizes now that there could be an insufficient amount of raising that could even stop inflation if, let's say, oil prices get going again. He admitted that he didn't think that the raising rates could do anything about that, or even with food supply. And then at the same time, he recognizes the fact that in the last few months, he sees the possibility of recession. So two things is, one is incredibly honest, and two is, seems like he doesn't really have a major plan here. It's almost like knee-jerk reaction to this, knee-jerk reaction to that. And it makes you kind of worry about the whole, not only central bank monetary policy, but even if we're looking at the government. And I hate saying these things, John, I really do. But that level of skepticism about everything is really what we're seeing. I think probably the most dangerous part of the market right now is, who do you believe, where are we going? And even price, which clearly is what us traders like to follow the most, is confusing as well, because it's gotten stuck and you don't know if we're going to see levels clear because people are going to go, okay, it's not so bad, or we're going to see another real major dump lower, maybe another 100 points or so in the S&P.
Is that why, Michelle, perhaps the argument's being made that even though we've seen some technical levels or indicators within, let's say, the S&P 500 that would suggest, compared to recent measures, some stocks might be quite oversold, and yet there just isn't that desire on the part of investors to make any big bets at this time?
Well, we're certainly not seeing any institutional investment coming into the classic areas they would come into, which would be growth stocks. And I was just reading today that JP Morgan reports that 40% of traders that they have talked to in their polls are really keeping a tremendous amount of cash at hand at this point, which clearly I can tell you from our own standpoint is the case here, not only with our asset management company, but also with the discretionary trading account that I run. It is really treacherous out there, and you have to step back and say, when opportunity strikes, go in. But if there's no opportunity or it's this confusing, having some cash on hand is smart. So yeah, it's treacherous. And this is, by the way, not surprising, because people are saying recession and now they're saying inflation, but they seem to be forgetting, except for me, maybe in good company Ray Dalio, that this is stagflation. And this is what stagflation looks like. If you go back to the 70s, and I always like to go back to that time, we had a couple of runs, but the market went really sideways for years. And then the factors started to evolve with a more accommodative Fed at the time, where we started to see the next peak rise in oil, and then the metals followed suit. But we're not seeing that right now. Right now, everything's like, oh, what's next? Nobody knows. I've never seen anything like this in a really, really long time, if ever.
And before I let you go, just to make some comparisons, the market makeup in the U.S., that heavy skew towards growth companies, which resulted in underperformance for U.S. stocks compared to, let's say, Canada for much of this year. I mentioned this month we've seen double-digit percentage declines for energy stocks. Our materials group, investors giving up on copper names, for example. Financials have had a rough stretch as well. So this could end up being a worse month for the TSX than the S&P 500. What's your take on that?
Well, what's so interesting about this whole valuation question, and the fact that financial planners are still very much vocal about, you got to stay in the game, the market always comes back and valuations look cheap is that the Case-Shiller, the ratio, the PE ratio, is at 29, which is still, it's down from the highs, but still near historical highs. So really, basically, what we're seeing now is just massive liquidation across the board. And at some point, that will settle. And I do believe, by the way, and interestingly enough, by the way, the long bonds are actually up, which means yields are down.
Yeah.
So there's that flight to safety. I think eventually, when the dust settles a little bit, I'm still a believer in the fact that commodities, you cannot reproduce things that have been in shortage, and there is a lower demand now in certain levels, certainly in the finished product with dining out, et cetera, but you still have to feed people, and people still need energy. And so once this dust settles, I still believe that that will be a new opportunity, a lot cheaper and a lot lower risk than it was, say, a month ago when everything looked really expensive, including oil.